All right. I've spoken about this topic several times in the past, and this is to do with the key financial metrics that investors look in a startup. So, if you are sort of applying for funding, you're seeking funding, then these are the key metrics. Now, I've talked about these key metrics many times in the past and also mentioned them in a lot of different occasions, but today I wanted to just kind of refresh this topic because I get a lot of questions on LinkedIn, on Twitter about these metrics. So I wanted to dwell into them just to see how to look at them from a funding perspective. All right. So first of all, understanding the importance of financial metrics for fundraising. It's very critical because I get it. I get it. You're busy, you got an idea, you're doing your MVP, you're putting a team together. And the financial metrics, the financial model, maybe you paid someone to do it, which is good, which is fantastic. Because doing them yourself, if you're not experienced, is is going to be one of the reasons why your funding takes forever, right? But having an idea is always good. And in fact, getting to know these metrics and really focusing on them so that they become second nature to you will actually enable you to also think through your business models, your strategies, and things like that. So it is very critical. Now, metrics to showcase your startup's growth potential and financial health. These are the kind of metrics that you need to look at and pay attention to. And if required, pay someone to create these for you on your pitch deck. And this is about the growth potential and financial health. Because an investor, yes, they're interested in your idea initially when they're looking at when you pitch them or you send them, you're trying to build a relationship. They'll be interested in your idea. Okay, what sector? Okay, oh really? Oh, fine. Yeah, that's fantastic. That sounds interesting. And then they say, send me a pitch deck. They will look at the idea, but what they're really interested in is the startup's growth potential and the financial health. And trust me when I say this, because I am an investor myself. I'm an angel investor. I'm also part of a syndicate of family offices and angel investors that I represent. And I have facilitated over $35 million of funding in the last couple of years, a few years. So I know how investors think, and this is how I think. So I'm opening the kimono, so to speak, so that you get the perspective when you're reaching out to funding and all that. Okay, customizing metrics to your industry and business model. So knowing these metrics, the important ones, and then customizing them to your industry is very important, right? So don't just copy and paste or just okay, so you know a particular metric. This is how it's supposed to be. No, think through. Okay, this is how it is supposed to be, but does it make sense to my industry? Does it make sense to my sector and all that, right? Okay, so what are these metrics that you need to pay attention to and what investors look for in a startup, especially when you're seeking funding or even when you're scaling? Monthly recurring revenue, MRR, or annual recurring revenue, ARR. The significance of MRR, ARR in SaaS and subscription based startups cannot be emphasized enough, right? Because if you have a subscription model, and I've done a live show on different kinds of models, and I will suggest you go and take a look at that just to understand the different kinds of models out there and how to think about a model and what to do about it. But if you're in the SaaS sector, then the MRR, ARR is one of the biggest kind of metrics that investors look at. Now, an MRR, monthly recurring revenue, doesn't have to be spectacular, right? If you're bootstrapping and you have a decent user base, out of which you have a decent set of or proportion or ratio of paid users, then it's okay. Don't panic if you're only making $1,000 a month, or if you're making $10,000 a month, right? Of course, if you're making $50,000 a month, $100,000 a month, this does not apply to you. But if you're making a very little kind of MRR, then extrapolate that into ARR. And it's okay, be confident because look, you're bootstrapping. And as I always say, investors are not idiots. They understand, they know. Okay. And most of the investors have been founders themselves. They've launched startups, they've exited, like myself. I've launched and I've invested in over 20 different startups, and I've had 4 successful 7-figure exits. So I know what it takes to build a startup, to bootstrap it, and then to get funding, to scale, to grow, to scale, and then finally to exit a startup. So, but being aware of it is very important. And of course, yeah, you will mention that, but have a flair. Okay, tell a story around that MRR. Revenue growth as an indicator of market traction and product market fit. So an MRR, it's actually MRR is a revenue growth indicator. It's an indicator of market traction and product market fit. If you're saying that your MRR is only $1,000 a month, but it started at 100, and in the last 3 months it's gone to this. Okay, I'm trying to keep the number simple. Yeah, $1,000 MRR is not really. I mean, if you apply, it depends on how much you're applying for, right? So if it's seed funding, pre-seed, and you're applying for $100,000, that's okay. But if you're applying for $500,000, then you need to have at least $10,000 MRR. Now, these are not rules of thumb. Okay, this is not scientific. This is based on my experience. This is my show, so I give you my experience, and I'm sure if you are an investor yourself, a VC or whatever, you might be laughing at these numbers. But I'm trying to simplify it. I'm trying to dumb it down so that we're looking at concepts. It doesn't matter X, Y, Z. It doesn't matter $1,000, $10,000. You see what I'm saying? Okay, so market traction and product market fit is what investors are looking for. They want to know that there is market traction, that it is a viable market, and that your product fits the market, right? That you understand that. And then how to optimize your MRR. How do you optimize this? Acquisition, expansion, and retention strategies. So once you have this MRR slide, you mentioned that also support it through a set of strategies of how you're going to acquire or expand or retain your kind of subscription base, right? Those will then give confidence even if you have a small MRR or ARR. Okay, so those are like acquisition, right? You know about acquisition, and even if you are a startup that's bootstrapping and even you're very small, you can still think about acquisition, and it's good to think about acquisition down the line, right? If it's a complementary service, you don't want to spend money developing your own thing. There's something out there, you're getting it for cheap, you buy that, you plug it into your system. Okay, the next one is customer acquisition cost. If you've been following my live episodes, then you know I love this metric, and I think this is the holy grail of success, right? CAC, customer acquisition cost, is very relevant in assessing marketing and sales efficiency. Okay, so if you, in your pitch, in your kind of pitch deck, if you're saying that your customer acquisition cost started out at being $50 a customer to acquire 3 months ago, and over the last 3 months you brought it down to $10, that says that you got a great marketing strategy and you have sales efficiency, right? So it's not just about saying, oh, the CAC for us is $12. Oh, okay. What does it mean? So give relevance. Try to show the progress, especially if it's going down. If it's going up, you got a bigger problem there, right? Don't go for funding yet. Fix that. Sort that out. Customer acquisition cost payback period. This is very important. How long it takes to recover the cost of acquiring a customer. Because if your subscription model, you charge $7.99 a month, but it costs you $799 to acquire a customer. Yeah, right? Okay, so you got to figure that out. Calculate that. How long does it take to recover the CAC, right? Because that gives an indication of how efficient you are. If it's going to take 3 months to recover, okay. But then again, it depends on your business model because 3 months, the customer might bail on you. And that means it's a loss. You spent $100. You charge $33 a month. It takes 3 months to get the $100 back. But if the customer bails in the second month, you're down $33. So this CAC payback period is very critical. Strategies for lowering customer acquisition cost: targeted marketing, automation, and referral programs. There are many strategies out there, but here are some that you may find useful. Targeted marketing. If you don't have an awesome strategy, marketing strategy, coupled by a brand strategy, positioning, messaging, and all that, great visuals, brand identity, okay, all that. If you are not targeted, then what happens is that you will be spending a lot of money acquiring customers that may not be the right customers for you. So it has to be very targeted. Automation. Use automation so that you're cutting down on costs of salespeople, for example, or the sales process itself. And then, of course, referral programs. Referral programs are fantastic. If someone refers your business, and they get a 20% referral fee, then they will be motivated to refer your business, right? Referral programs. Okay. Next, customer lifetime value. Another one that I'm really interested in. Understanding lifetime value as a measure of customers' long-term financial value to the business. So if the long-term value of a customer is $200, lifetime value is $200, and your customer acquisition cost is $50, bad business model, right? So because that's all you're going to get from this customer, $200. And that means only $150. It's okay. Yeah, but this is not about being okay. This is about, being great, right? Now, lifetime value to CAC, customer acquisition cost ratio, ensuring a sustainable business model. This is what I was just saying. If the lifetime value of a customer is $1,000, and it costs you $10 to acquire this customer, that is a business I would invest in straight away, based on other factors too. Okay. Boosting. How do you boost your lifetime value? Focus on customer success, upselling, and reducing churn rates. Just 3 strategies. There are many out there, but you got to focus on customer success. The customer has to find value in your subscription, right? Because think of a subscription model or any SaaS model, any business model as the transfer of value, right? So you're transferring value to your customer. Your customer is transferring back some money. Now, I always say that the value you transfer your customer must be more than the value of the money they pay you. If they're paying you $30 a month, you should be saving them $100 in terms of time or whatever. That is good value. If they're paying you $30 and you give them $20 value, they're going to bail on you in a few months, and their lifetime value goes down. So you want to increase the lifetime value of your customers? Make your customer successful. Upselling is another way, of increasing the lifetime value, and then reducing churn rates. If they don't bail, they are more valuable to you. So make sure they don't bail on you. Gross margin. Gross margin is a measure of your startup's profitability. Very important. Importance of gross margin for scalability and long-term financial health. Because if your business is not profitable, it's not attractive to investors because it could die anytime. Improving gross margin. How do you do that? Optimizing pricing. Oh my God. Cost reduction and process efficiency. Optimizing pricing. You will not believe the number of businesses that are struggling because their pricing strategy sucks, right? They don't know. It's arbitrary or based on competitors. It's not based on the value they're providing. It's not based on the value proposition. It's not based on their customers. So optimize your pricing strategy. Figure that out. It's a different episode. If I haven't already made it, I will make it sometime. And I will talk about how to optimize your pricing strategies. Then there is the cost reduction. Always be looking to reduce your cost, but not at the cost of customer success, right? So it's like the, iRobot. I don't know if you watched that film. Isaac Asimov said these 3 rules of robotics, right? That, a robot cannot harm a human. A robot has to take care of itself, but not at the expense of point number 1. Because let's say you're beating up a robot, right? Then it has to protect itself. It might harm you. But the rule number 1 says, do not harm a human. So you see where I'm going with this, right? So yes, reduce costs, but not at the expense of customer success. Very important. Process efficiency. You got to improve your process. Go for Kaizen. Small, little improvements in process on a daily basis make a huge difference, improvement. Burn rate on runway. Very important. The rate at which your startup consumes capital is burn rate. So if you've already been funded and you've had $100,000 funding, 3 months ago and you're left with $10,000 now, that means you're spending $30,000 a month. That is your burn rate. $30,000 a month. That is insane, especially if you only got $100,000. Well, it may not be insane if it's for the right reasons, but burn rate is very important. Runway, the amount of time before your startup runs out of cash. Well, same example. Now 3 months later, you got 10,000 in the account. What kind of time do you have? None. You've run out of time because you need $30,000 a month, but you only have 10. So game over, right? Unless you can produce the other 20,000. And presumably that's why you're seeking funding. But that's a bad sign. Go to funding. If you already have some bootstrapping or pre-seed, if you're going for seed, go when you have some runway left. Managing burn rate and runway. How do you manage this? Cost optimization, revenue growth, and fundraising. 3 ways of doing it. Cost optimization, stop spending a lot of money, okay? Cut down on the money you spend. Revenue growth, increase your revenue so that it starts, giving you more runway. And then, of course, fundraising. You can raise more funds to increase the runway, but not to sustain the burn rate, right? If your burn rate is not optimized, then your runway becomes shorter. That means you're going to funding to increase the runway. That's bad. The investor is going to see right through that. First of all, optimize your burn rates to such an extent that you cannot reduce that anymore without affecting, customer success and things like that. Then you go for additional funding. Key performance indicators tailored to your industry. Very important. KPIs, not generic, but to your industry, right? Identify, first of all, industry-specific KPIs that matter to investors. So if you're in the fintech and you're going after investors that know fintech, they will be looking for certain kind of KPIs that are industry-specific, fintech-specific. Identify those, and those should be in your pitch deck. Incorporating KPIs into your pitch, storytelling and data visualization. So if you identify some KPIs that are related to your industry segment, then create a story around them. Why they're important to you, how you're looking at them, what is your understanding of these KPIs, and how you're going to optimize them and mitigate them, and all that, and use data visualization. Demonstrating competitive advantage through industry-specific KPIs. Because you will have an advantage if you can take one of those KPIs, which is industry-specific, and show the investor how you're going to optimize it and use it to your advantage, because then you have a competitive advantage. Okay. Conclusion. The importance of understanding and tracking key financial metrics cannot be understated. I always say that. Educate yourself. Spend a week doing nothing but this. Get yourself educated. Go on there. Read about these different metrics and how they're important to you. So it's not just about knowing the definition, but applying them to your business. Incorporating these metrics into your fundraising pitch and internal decision making. They'll make you a better startup founder. They'll make your startup better. They'll make you more attractive to investors. Continuous improvement, monitoring, adjusting, and iterating on your startup's financial performance. So always be monitoring them. And I keep saying this. I keep banging my head on the table against this because, oh my God, founders don't really monitor metrics. Then you need to adjust them. And then iterating on your startup's financial performance to get the best outcome, right? Okay, so that is the topic for today, which is key financial metrics. And if you have any questions, just hit me up on LinkedIn, send me a message, or on Twitter, and I will try and answer them. All right, till my next live show, which is tomorrow, go forth and prosper.